If you are 65 or older, there is a tax change you need to know about in 2026. And depending on your income and filing situation, this change could potentially reduce the amount of income that is subject to federal income tax. We're talking about a new enhanced senior deduction of up to $6,000 per eligible person. For a married couple where both spouses qualify, that can be up to $12,000. But there is an important detail. This is not simply a $6,000 check from the government, it is a tax deduction. And that means you need to understand how it works, who qualifies, what the income limits are, and how it could interact with your other retirement income. In today's video, we're going to break all of this down in simple language. We'll also talk about Social Security, retirement accounts, the standard deduction, income limits, married couples, and some common mistakes people could make when thinking about this new tax benefit. So if you're 65 or older, or you're planning your retirement and will soon reach 65, stay with me because this could be an important part of your 2026 tax planning. Let's start with the most important question. What exactly is this $6,000 senior deduction? The IRS says that for tax years 2025 through 2028, individuals who are age 65 or older may be eligible to claim an additional $6,000 deduction. And this deduction is in addition to the existing additional standard deduction available to seniors. That means this new provision is separate from the normal senior-related deduction that already exists under tax law. For an eligible individual, the new deduction can be as much as $6,000. For a married couple where both spouses qualify, the amount can be as much as $12,000. Now, before you get too excited, there is an important limitation. The deduction begins to phase out when modified adjusted gross income goes above certain thresholds. The IRS says the phase-out begins above $75,000 for individuals and above $150,000 for married couples filing jointly. So not everyone who is 65 or older will necessarily receive the full $6,000. And that's one of the biggest things you need to understand. This is not a universal $6,000 benefit for every senior. Your age matters, your income matters, your filing status matters, and your tax situation matters. So let's take this step by step. First, let's talk about age. To qualify, you generally need to be age 65 or older by the last day of the tax year. For 2026, that means you need to be 65 on or before December 31st, 2026. So if you turn 65 during 2026, you can potentially qualify for the deduction for that tax year, assuming you meet the other requirements. This is important because some people mistakenly believe they need to be 65 at the beginning of the year. That's not necessarily how the rule works. The key is whether you meet the age requirement by the end of the tax year. Now let's talk about the amount. The maximum new deduction is $6,000 per eligible person. Let's say you're single and you're 67 years old. If you meet the income and other requirements, you could potentially qualify for up to $6,000. Now imagine you're married and both you and your spouse are at least 65. In that situation, the maximum can be $12,000. That sounds like a lot of money, but remember what the word deduction means. A deduction generally reduces the amount of income subject to tax. It does not mean you automatically receive $6,000 in cash. For example, let's say you have $50,000 of taxable income before applying this deduction. A $6,000 deduction could potentially reduce that taxable income to $44,000, depending on your overall tax situation. The amount of tax you actually save depends on your tax circumstances and marginal tax rate. So don't think of this as $6,000 goes into my bank account. Think of it as $6,000 may be deducted from my taxable income if I qualify. That distinction is extremely important. Now let's talk about something else. Can you claim this deduction if you take the standard deduction? Yes. The IRS says this enhanced senior deduction is available to eligible taxpayers whether they claim the standard deduction or itemized deductions. That makes this provision especially interesting. You don't necessarily have to itemize your deductions to benefit from it. And that's important because many retirees use the standard deduction. Let's say you don't have enough itemized deductions to make itemizing attractive. You may still be able to claim the new senior deduction if you meet the eligibility requirements. Now let's talk about income. This is where things become more complicated. The IRS says the deduction begins to phase out for taxpayers with modified adjusted gross income above $75,000. For married couples filing jointly, the threshold is $150,000. So let's say you're single and your modified adjusted gross income is comfortably below $75,000. You may be in a position to receive the full deduction, assuming you meet the other requirements. But what if your income is higher? Then the deduction may be reduced. And if your income is significantly higher, you may eventually lose the benefit entirely. This is why retirees shouldn't simply look at their Social Security check and decide whether they qualify. Your total income picture matters. You could have Social Security. You could have pension income. You could have IRA withdrawals. You could have 401k withdrawals. You could have investment income. You could have interest. You could have dividends. And all of these pieces can affect your overall tax situation. This brings us to one of the most important points in this video. Social Security is not the only number you should be looking at when planning your taxes. Let's say your Social Security income is $30,000 for the year. That doesn't necessarily mean your total income is $30,000. You might also have $20,000 coming from a traditional IRA. You might have $10,000 from a pension, and you might have investment income. Your tax picture could therefore look very different from someone who receives the same Social Security amount but has no other income. This is why retirement tax planning requires looking at the entire picture. Now let's talk about married couples. If you're married and both spouses are at least 65, the potential maximum deduction is $12,000. That's $6,000 for one eligible spouse and another $6,000 for the other eligible spouse. But again, the income phase-out matters. For married couples filing jointly, the phase-out begins above $150,000 of modified adjusted gross income. So a married couple should not automatically assume, we're both over 65, so we get $12,000. Instead, you need to look at the income rules. And this is a perfect example of why tax planning is about more than just knowing a headline. The headline might say, new $6,000 tax deduction for seniors. That's attention-grabbing. But the real question is, do I qualify? And how much can I actually claim? That's the question you should be asking. Now let's talk about another important issue. What if you're receiving Social Security and taking money from a retirement account? This is very common. Many retirees have multiple sources of income. You might receive Social Security every month. You might also withdraw money from a 401k or traditional IRA. Those withdrawals can affect your overall taxable income. So before taking a large retirement account withdrawal, it's worth understanding how that withdrawal could affect your tax situation. You shouldn't necessarily avoid withdrawals just to remain under a particular income threshold. You still need money to live. But if you're deciding between taking a larger withdrawal in 1 year versus spreading withdrawals across multiple years, tax planning may be worth considering. This is especially important for people who have flexibility. Let's imagine you need $30,000 from your retirement account over the next 2 years. Depending on your circumstances, it might matter whether you withdraw $15,000 in each year or take a different amount in 1 year. The best choice depends on your complete financial picture. And that's why this video isn't telling you to make one specific move. Instead, we're showing you what to watch. Now let's talk about the standard deduction. For tax year 2026, the federal standard deduction is $16,100 for single filers and married individuals filing separately. For married couples filing jointly, it is $32,200. For heads of household, it is $24,150. And taxpayers who are 65 or older can also have an additional standard deduction under existing tax rules. Then you have the new enhanced senior deduction. So when you add these pieces together, eligible seniors may have a significantly larger amount of income protected from federal income tax than they might realize. But again, don't simply add every number you see online without understanding the rules. Your filing status matters, your age matters, your income matters, and your specific tax situation matters. Now let's discuss a common misconception. Some people may hear about this new deduction and think, that means my Social Security won't be taxed anymore. That's not what this provision means. The new senior deduction does not automatically make Social Security benefits tax-free. Federal taxation of Social Security benefits follows its own rules. Depending on your combined income and other factors, some of your Social Security benefits may still be taxable. The deduction may reduce your overall taxable income, but it does not simply erase the separate rules surrounding Social Security taxation. That's why you need to look at the whole tax return. Now let's talk about another issue. What happens if you're just turning 65? Suppose you turn 65 in December 2026. You may still meet the age requirement for the 2026 tax year because the IRS says the taxpayer must be age 65 or older on or before the last day of the tax year. That means the timing of your birthday can matter. So if you're turning 65 this year, don't assume you have to wait until 2027 before looking into the deduction. You may qualify for the 2026 tax year if you meet the other requirements. Now let's talk about income planning. This is where the new senior deduction becomes more interesting for retirement planning. Many retirees have some control over when they take money from certain accounts. For example, if you have money in a traditional IRA or 401k, you may have some flexibility over withdrawals, subject to applicable rules and required minimum distributions when those apply. That flexibility can sometimes be useful for tax planning, but again, don't make a withdrawal decision solely because of the $6,000 deduction. You need to consider your cash needs, investment strategy, taxes, required distributions, and long-term retirement plan. The deduction is one piece. It's not the entire strategy. Now let's talk about required minimum distributions, commonly called RMDs. Once you reach the applicable RMD age under current law, you generally have to take required distributions from certain retirement accounts. That means some retirees may not have complete control over how much income they receive from retirement accounts. If an RMD pushes your income higher, it could affect your eligibility for certain tax benefits or deductions. Again, this is why you should review your tax situation before the end of the year. Don't wait until you're sitting with your tax preparer months later and discover that a financial decision you made earlier had an unexpected tax consequence. Planning earlier can give you more options. Now let's talk about one of the smartest things you can do. Estimate your income before the end of the year. Take your expected Social Security income. Add your pension income. Add your expected retirement account withdrawals. Add interest and dividends. Add other taxable income. Then compare your estimated modified adjusted gross income with the thresholds for the senior deduction. You don't have to be a tax expert to start this process. You can simply gather your documents and create an estimate. If your situation is complicated, a qualified tax professional can help you calculate it more accurately. Now here's another important point. The new senior deduction applies for tax years 2025 through 2028. So this isn't necessarily a one-year-only opportunity. But that doesn't mean you should ignore it. Tax rules can change, your income can change, your age can change, your filing status can change, and your retirement withdrawals can change. So review your situation each year. Don't assume that because you qualified in one year, you'll automatically qualify in another. Now let's imagine a hypothetical retiree. We'll call her Susan. Susan is 68. She's single. She receives Social Security. She also takes withdrawals from a traditional IRA. Her income is below the phase-out threshold. If she meets all applicable requirements, she may qualify for the full $6,000 enhanced senior deduction. Now imagine another retiree. We'll call him Robert. Robert is also 68, but his income is substantially higher because he has a large pension, investment income, and significant retirement account withdrawals. Robert may not receive the same full deduction. Same age, different income, different tax result. This example shows why age alone doesn't determine eligibility. Now let's imagine a married couple. Both spouses are over 65. Their income is below the applicable phase-out threshold. They could potentially qualify for up to $12,000 in enhanced senior deductions. Again, that's a deduction, not a $12,000 payment. But reducing taxable income can potentially lower the amount of federal income tax owed, depending on their situation. Now let's talk about what you should not do. Don't make a large financial decision just because you heard about the $6,000 deduction in a YouTube video. Don't withdraw thousands of dollars from a retirement account simply because you think it will somehow increase your tax savings. Don't change your Social Security strategy without understanding the long-term consequences. And don't assume that every senior qualifies for the same amount. Instead, use the information as a reason to review your finances. That's the smarter approach. Now let's talk about the 2026 tax year itself. The IRS has already published the relevant tax information for 2026. The standard deduction is higher than it was in 2025. The new senior deduction is available to eligible seniors, and retirement contribution limits have also increased. For example, the 2026 employee contribution limit for many 401k plans is $24,500. For people age 50 and older, the standard catch-up contribution limit is generally $8,000. And for certain workers who are ages 60 through 63, the higher catch-up limit is $11,250 for 2026. The IRA contribution limit for 2026 is $7,500, with an additional catch-up amount available for eligible older savers. These changes matter because retirement planning isn't just about taxes after you retire. If you're still working, your contribution strategy can also affect your future retirement income and current tax situation. So if you're 65 but still working, don't assume this video is only for people who have completely stopped working. The new senior deduction can be relevant to eligible taxpayers who meet the requirements, whether they are still working or retired. And if you're still contributing to a 401k, the higher 2026 contribution limits may also be relevant. Now let's talk about a practical checklist. Step 1. Find your age and filing status. Step 2. Estimate your 2026 income. Step 3. Separate your income sources: Social Security, pension, IRA, 401k, investments, interest, other income. Step 4. Estimate your modified adjusted gross income. Step 5. Compare that number with the applicable phase-out threshold. Step 6. Check whether you qualify for the enhanced senior deduction. And Step 7. Before making a major tax decision, consider getting professional advice. This process can help you understand where you stand. Now, there's one more thing you should know. Tax deductions and tax credits are not the same thing. A tax credit generally reduces the amount of tax owed directly. A deduction generally reduces taxable income. The $6,000 senior provision we're discussing is a deduction. So if you qualify for a $6,000 deduction, that does not mean your tax bill automatically drops by $6,000. Your actual tax savings depend on your tax situation. This is a very common misunderstanding, especially when people see a large number in a headline. So remember, $6,000 deduction does not equal $6,000 cash. It means potentially $6,000 less taxable income for an eligible individual, subject to the applicable rules. Now let's talk about why this could matter for retirees. Retirement income often comes from several sources. During your working years, you might have received a paycheck from one employer. In retirement, your income can be much more complicated. You might receive Social Security, a pension, IRA distributions, investment income, part-time work, rental income, and other sources. That means tax planning can become more important, not less important, after you retire. And this new senior deduction gives eligible taxpayers another factor to consider. It's not a reason to panic. It's not a reason to make risky financial moves. It's simply another tax rule that could potentially work in your favor. Now, here's my biggest recommendation. Don't wait until the last minute. If you're 65 or older, start gathering your information now. Look at your previous tax return. Look at your Social Security statements. Look at your retirement account statements. Look at your pension information. Look at your investment income. Then estimate what 2026 will look like. That gives you time to ask better questions. And better questions can lead to better financial decisions. Remember, the IRS rules are detailed, and individual circumstances can affect eligibility. So always check the latest IRS guidance or consult a qualified tax professional before relying on this deduction for your personal tax planning. Now let's summarize everything. If you're 65 or older in 2026, you may be eligible for a new enhanced senior deduction of up to $6,000. If you're married and both spouses qualify, the maximum can be $12,000. The provision applies for tax years 2025 through 2028. The deduction is available to eligible taxpayers whether they itemize or take the standard deduction, but the benefit begins to phase out above $75,000 of modified adjusted gross income for individuals and $150,000 for married couples filing jointly. So income matters, age matters, filing status matters, and your complete tax situation matters. This is not a $6,000 government check. It's a potential deduction that can reduce taxable income. And that distinction is extremely important. If you receive Social Security, don't assume this automatically makes your benefits tax-free. If you have an IRA or 401k, don't make withdrawals simply because of this deduction. If you're married, don't assume you automatically qualify for the full $12,000. And if your income is close to the phase-out threshold, consider getting professional tax guidance before making major decisions. The biggest lesson here is simple. Retirement planning isn't just about how much money you receive. It's about how much you keep after taxes and expenses. And understanding tax rules can sometimes be just as important as earning more money. So if you're 65 or older, take a few minutes to review your 2026 tax situation. You may discover that there are opportunities you didn't know about. And if you're still working, this is also a good time to review your retirement contributions, because 2026 contribution limits have increased for several retirement accounts. The goal isn't to chase every tax break. The goal is to understand the rules and use the ones you're actually eligible for. Because when it comes to retirement, small financial decisions can add up over time. And the more you understand about your taxes, retirement income, and available deductions, the more confident you can be when making financial decisions. If you found this video helpful, make sure you subscribe to the channel. We'll continue covering U.S. retirement, Social Security, taxes, inflation, 401ks, IRAs, Medicare, and other important personal finance updates. And remember, this video is for educational purposes only. Tax rules can be complicated, and your personal situation may be different. Always verify your eligibility using current IRS guidance, or speak with a qualified tax professional before making an important tax or retirement decision. Thanks for watching, and I'll see you in the next video.